So Shawneel, this is a video to go through a financial model using a Section 13 deduction, which is applied to buy-to-let residential properties in South Africa. Section 13 was introduced around 2008 as a tax deduction that can be applied to in properties that are rented out from inception. And the objective behind the Section 13 deduction is to bring down your profit before tax before you actually start paying tax in the entity in which you've purchased the properties in. So what I'm going to do is I'm going to go through a hypothetical scenario of 5 properties that meet the criteria, and then I'm going to turn on Section 13(6) as a deduction, turn it off, so I can show you how the Section 13 deduction can be applied practically if you're looking to utilize the tax benefits that are currently available to investors. So this is a scenario of 5 properties. I've essentially just made up 5 purchase prices. I've used different cash flow metrics. None of this is exactly accurate, but it's just to illustrate to you an example of how a financial model can be used to extrapolate cash flows over a 30-year period and also see the tax benefits. So just to summarize Section 13(6), you are familiar. Section 13(6) is a deduction that allows you to deduct a minimum of 55% of the acquisition cost of 5 or more properties that meet the criteria for the deduction in South Africa, which is basically properties that have to be bought for buy-to-let purposes. It has to be bought new and unused, in other words, directly from a developer of plan. It has to be within the same tax number. You can't have 5 properties scattered across 3 different entities, as an example. And the properties have to be rented out from inception. You can't have it as a primary residence and then convert it into a rental property down the line. It has to be rented out immediately. You have to have a lease agreement from the date of registration when you place the first tenant. If you meet those criteria, then you're allowed to deduct the 55% minimum. The reason why I say minimum is because this is for sectional title in this example. If it's for full title or plot or plan, then the land is not deducted, but the improvement of the land is, which means that you could have a higher deduction applied, such as 60% or 62%. But in most cases, 55% because it is sectional title, and that is the most common rental property in South Africa. So in this example, 4,666,000 is the acquisition cost across 5 properties. As you can see, there's a variety of prices. The average price is 933,200 Rand. 55% of the acquisition cost, if you break it down, is 2,566,300. And this is the allowance for each property, which is basically 55% of the acquisition cost. And this is then deducted over a 20-year period. In other words, you're allowed to deduct this 20 times or 20 financial years from the moment the 5th property has registered that meet the criteria, which means that this amount here is what's going to be applied when you do your financial returns, so that you can bring down your profit before tax as an additional deduction so that you can pay less tax or prolong paying tax on your portfolio as your properties are either breaking even or generating profits over time. So in this example right now, I've used 100% finance. There's no deposit. And this is what the cash flow looks like. So what I've done is I've taken 5 hypothetical properties, put in some values there, and the assumptions across the board is that it's 30-year bond terms, it's 11.75%, which obviously is a very high interest rate currently. Working on a capital growth of 7, rental escalation of 6, inflation of 6, and the rental management in this case 11.5%, including VAT, and rental insurance of 3.5%, which rental insurance is optional. You don't have to have the rental insurance. As you can see, it does add up. So if I were to turn that off, you would save 1,267 Rand. But let's just hypothetically say that this investor was wanting that. The annual shortfall in year 1 based on 100% finance is 20,001 Rand. which equates to 240,013 over the year. So if we take that amount and we put it over here as the surplus shortfall for the year, obviously noting that this is just a straightforward calculation. In reality, the interest portion of the bond is a deduction. You might have maintenance and other costs that you would then deduct, which we haven't factored in here. If there's accounting services, the most likely will be, and fiduciary, if you're going to be utilizing a trust attorney, you would include those costs here, which are also tax deductions. But in this case, 240,013 Rand is the loss. Based on 100% finance, you'll pull through the Section 13 deduction over here and apply it, which means that the loss for the year is 368,328. And that's the assessed loss that will be given to SARS, which you obviously don't pay tax on. This will then carry over into the next year. You apply the same scenario based on these assumptions across the 5 properties, and your cash flow then starts to improve, 19,380, 232,562. You do the same scenario, and your assessed loss rollover is now 729,205. So now if you roll this over, applying the Section 13(6), you are now increasing your accumulated losses over time to the point where you will get a profit that exceeds the Section 13 allowance, which in this case is 128,315. And we can see over here that there's now a profit being made of 3,000 Rand because the annual income of these 5 properties exceeds the Section 13 deduction. So it's 3,000 profit. However, now you need to start applying those assessed losses and start reducing them, because now you've got that assessed carry rollover that you now have to start applying to your tax. So in this case, this particular scenario, 27 years, you'll start having to declare a profit after having the Section 13 and utilizing all those assessed losses that have been carried forward, which is a good thing if you don't want to pay tax for a few decades. Now, if I take the Section 13 and I turn this off and don't apply the deduction, you will still make losses, because we've already said 20,001 times by 12 is 240 and 13. You're going to continue making it. However, you're not going to have as large of an assessed rollover. So you will start applying your accumulated losses, to start applying that sooner, and you will start paying tax in year 23, which means that you've got 3 additional years where you will not have tax applied or tax payable if you had the Section 13. So the reason why to explain this is because if a client is contemplating buying a property that is purely Section 13, or if a property is making a lot more financial sense from a cash flow point of view, and you can get 100% finance, go the option of getting the better cash flow, because as you can see in this scenario, it's going to take you a very long time before you actually start seeing the benefits of Section 13, unless you break even sooner, which is what I'm going to show you now. So now I'm going to change the deposits on these properties to 20%. So 80% finance. Here's the 20% deposits. And I'm going to switch on the Section 13. So in this case, with the 20% deposit, you're breaking even within 9 years. And with these properties now, you have the Section 13 deduction. Your losses obviously have been reduced. Your shortfalls rather from 20,000 to 10,000. Annualized is 126, applying the Section 13. So this is again the same scenario. And if you do the same exercise in year 23 versus year 27, is the difference between 80% and 80% finance and 100% finance. So as you can see here with these different scenarios, again, even putting down a 20% deposit, you're not necessarily going to see the benefits immediately. If I switch off Section 13, so we first said here with the Section 13 and 80% finance is 22 years before you start, 23 years before you start having to declare, which is over here. So if I now switch off this amount, the Section 13, you will start paying it in year 16. So year 16 is when you don't have Section 13 and you start having to declare a profit, because now your accumulated losses have been used up, versus over here, we've already said 23. So you can start to see the benefits of the Section 13 when you apply it in different scenarios. So it does make sense between the two. 1623 does make sense. But again, it is not immediate. You're not benefiting immediately from this benefit. So if I take the Section 13 off again, you'll still have all these assessed losses, all these losses, etc. You only have to start worrying in year 16. So you can acquire properties later down the line that do meet the criteria, etc. And then you can start to utilize that in the future if you need to. But again, as I said, it's not an immediate tax benefit that you're going to get as soon as the fifth property registers. You're not going to be getting benefits immediately if you're making losses. Now, on the converse of that, let's say now this person is going to break even immediately. They want to put down deposits, let's say 50%, and break even from day one. So in this case, they're making a surplus. So just to illustrate here, 50% finance. Same, I'm going to put on Section 13 quickly. Same deduction. In this case, they're making a surplus of 3,548, which annualized is 42,582. So there's the 42,582. Applying the Section 13, you now make a loss. So you're not going to pay tax because obviously this is greater than the actual profits that your taxable income. And then you continue doing the same exercise as before. And this particular person will start having to declare profits in year 13. However, they are going to be bringing down their tax liability still because they've got that Section 13, which is still going to be continued until 20 years have passed. So the point I'm getting at is that you definitely see benefits of Section 13 if you are breaking even immediately. And to illustrate that, if I take the Section 13 and turn it off and you don't have that 128,315, you are making profits and you have to declare these profits every single year, which means that you've got no additional deductions that you can apply. Not great. Now, to illustrate Section 13, the maximum deduction, I'm going to make this 100% now. Let's say this client wants to buy these properties cash. So there's no finance, total cash, no amount that's been financed. I'm going to turn on Section 13 again. And you can see now 27,098 Rand is the monthly surplus, annualized 325,176, 325,176, and you apply the Section 13. This particular person is bringing down their profit before tax to 196,861 from 325. And if you put that into a calculation, utilizing, let's say, a company as an example, this is the tax applied before the Section 13, and this is the tax applied after Section 13 has been used. This is the tax saving. If we do that every single year, because you're bringing down the tax every single year for 20 years, your total tax saving, if you sum this up, equates to 27% of the acquisition cost of the allowance, of the Section 13 allowance. So in other words, if you buy a property portfolio that breaks even, meets the criteria for Section 13(6), and you're making a profit in a company, you're going to save 27% tax over 20 years, which equates to 692,901. If you apply the same scenario in a trust, where we take the tax and we multiply it at 45% over here and 45% over there, there's your tax saving. If you extrapolate the tax saving over 20 years, which equates to 1,154,835, and that will then equal to 45% of the allowance. So in other words, if you buy these properties in a trust, you're going to save 1,154,835 Rand in tax. Now, just note that it may look great, the savings is higher, but you're paying tax at 45% and not 27%. So the point is, you want to get a lower tax rate on all income so that you don't have to pay additional tax unnecessarily, which in this case, the trust is 45%. So from a tax point of view, a company would make more sense because it's a flat rate. Now, if I turn off Section 13(6) again for this example, you'll see that there's no Section 13(6). So you're going to be paying the tax at these different marginal rates depending on which entity you've bought it in, every single year. There's no additional tax deductions. So Section 13 would make a lot of sense to do so. So hope this makes a lot more sense in terms of how Section 13(6) works practically. It is not cash back from SARS. SARS is not giving you back as a physical amount of 128 back to you. They're allowing you to deduct it to make additional deductions to bring down your profits before tax, so that your taxable income comes down by that further deduction when you do your tax returns. I've also put in the tax savings here for tax rates of 36, 39, 41. There may be scenarios where people buy properties in their personal capacity for the deductions. Just note Section 13(6) is not ideal in a personal capacity. SARS can ring fence your portfolio so that the Section 13 deduction is not incorporated with your personal tax liability. And second, you've got a state duty now by adding, in this hypothetical scenario, 4,666,000 rands worth of assets into your state, which you now need to make provisions for estate planning purposes. So hope this template helps, this explanation in terms of how Section 13 works practically. In summary, Section 13(6) works best if you're either breaking even immediately or two, breaking even fairly soon. It is not the main benefit if you're looking to utilize the banks as much as possible. In other words, 100% finance, 90% finance, or 80% finance. If the numbers make sense in terms of the cash flow, rather go for the property that has the better returns than just getting it for Section 13, because as we've seen, you only benefit much later down the line when you actually start applying all the assessed losses that are rolled over every single year. And that being said, thanks very much for taking the time to watch this video. If you have any questions or comments, please feel free to write them in the comment section. Bye for now. Ciao. Thanks.